Hello, everyone. This is David Schlossberg with the Short Concepts Group. I wanted to shoot this video today because we've had some major retirement and tax legislation that was passed today by Congress. Both the House and the Senate have signed this bill, and it's going over to the president to sign. So I imagine that it'd be completed in the next day or so. Probably by the time you're watching this video, it will be law. The bill is the Secure Act 2.0. And the Secure Act 2.0 is actually an overlay to a bill that was signed back in 2019. It stands for the Setting Every Community Up for Retirement Act. And in 2019, we saw Secure Act 1.0 pass. Now, Secure Act 1.0 is an absolute game changer for the retirement planning business. And for all of you that are accumulating money in pre-tax retirement accounts, like 401ks and IRAs. Because Secure Act 1.0 eliminated one major provision, and it allowed the individual who inherits a retirement account to basically stretch out the distributions over their life expectancy. Meaning that if I inherited a retirement account, let's say from a parent of mine, then essentially I can take a small distribution each and every year over my life expectancy. While Secure Act 1.0 had eliminated that provision. By stretching out the distribution, it also stretched out the tax that was due because I'm not taking out a big lump sum that's taxable in one given year. I'm taking out a little bit of money. It's like the slow trickle out of the faucet versus a fire hose. It's going to create a lot less taxes. Now, what Secure Act 1.0 did is Congress came in and said, hey, we need some of this money now. We can't allow people to slowly drain these inherited retirement accounts. We're going to mandate that they, within a 10-year period, expel the entire amount. It compressed the time frame to take money out of these accounts, which also basically accelerated the tax liability that a beneficiary would pay on these retirement accounts. And so Secure Act 1.0 made strategies like Roth conversions much more attractive. It made the utilization of life insurance for inheritance planning much more attractive. And it changed the way we utilize trust, like living revocable trust or irrevocable trust for estate planning purposes. Secure Act 1.0 also extended the age that we had to take required distributions out of these retirement accounts from age 70 and a half to age 72. And so again, a required distribution is when the government mandates or forces that you start taking a certain percentage out of your retirement account each and every year. While Secure Act 2.0 didn't have any massive individually changing reforms in the bill like Secure Act 1.0 did, where it eliminated or killed the very lucrative stretch IRA provision, but it does have a number of small things that I think add up to a lot of good stuff in totality. The first one is required minimum distributions. So if you have yet to turn age 72 this year, then your RMD age is no longer going to be age 72 anymore. It's actually going to be age 73. So that's one more year that you can continue to defer money in those retirement accounts before you're forced to take out a percentage of it. If you're really close to age 72 or 73, it might give you a little bit of extra time to do some strategic Roth conversions for another year before your RMD turns on. Now, if you're younger, your RMD age is going to continue to ratchet its way up. The goal is that by the year 2033, the RMD age will be age 75. Again, you need to think about this if you're doing multi-generational planning with your own assets, because if you continue to defer in tax-deferred accounts like IRAs or 401k, let's say to age 75, that might be a bigger balance left in those accounts when you pass away, which could wind up pushing your beneficiaries into a really high tax environment because of the new rules. And so again, these are all things that we need to think about when we add Secure Act 1.0 with Secure Act 2.0 into our plans and see how these items fit into your plan. The next thing that I'm a big fan of is that they reduce the penalty for missing an RMD. The penalty for missing one of your RMDs was 50%. It was one of the most extreme penalties in the entire tax code. So for example, if you had a $40,000 requirement of distribution and you actually missed it, then you're going to have a $20,000 tax penalty on top of the $40,000 of taxable required distributions. Well, Congress has decided to cut that number in half, and it's now going to be a 25% penalty. And if you fix the missed required distribution in a timely manner, they're going to be nice enough to drop that penalty down to 10% instead. Well, what a timely manner is yet to be defined. So don't miss those RMDs. One of my favorite provisions of this new law, Roth 401k matching. So again, if you're still contributing to a retirement account and you want to juice up some of that tax-free money that you have, traditionally we'd have to put money into a 401k. It could either go into a Roth 401k or a pre-tax 401k that was taxed later at distribution time. But when our company put matching money in, maybe they match 3, 4, 5, or 6%, or whatever we put in, that match always had to go into the pre-tax account, which was later taxable to you. Well, now you're going to be able to elect for that matching money to go into a Roth account to continue to build up tax-free monies for yourself and your family. So again, if you think that there's going to be higher taxes in the future, you want to try to get as much of that money in the Roth account as you can. Because again, that money is going to go tax deferred and come out tax free when you think the tax rates might be higher in the future. The next option in this bill is the Qualified Longevity Annuity Contract, otherwise known as a QLAC. This is for somebody who's retired that wants to take a chunk of the retirement money and basically segment it out into a longevity annuity. A longevity annuity is where you defer the money in that piece until you attain a certain age. Most of the time it's around age 80 or 85. Once you hit that age, the insurance company is going to pay you a lifetime income stream. Congress used to allow a maximum of $145,000 or 25% of your retirement balance, whichever was lower, to be deferred into one of these QLACs. Now they're increasing that to $200,000. So if you were to defer $200,000 in a QLAC, that could reduce your requirement in the distribution because the $200,000 is not calculated in the formula for your RMD. So there could be some cases where if you're worried about living a long time into your 90s, or perhaps past 100, and you're worried about outliving your retirement assets, you could reduce your current RMDs using one of these QLAC contracts. It could be an interesting strategy to take a look at for some. The next item, another one that I'm a big fan of, is catch-up contributions. Now, this isn't going to go into effect until 2025 because Congress needed to balance the budget. And that couldn't happen until 2025 based on the additional spending that was just enacted. But for any individual over the age of 60 and before the age of 64, you can now put a $10,000 catch-up or 150% of your regular catch-up into your 401k retirement plan. So it's the greater of the two. Let's play this out. Let's say that you're a 60-year-old and in 2023, you could defer $22,500. Because you're over age 50, you could do a normal catch-up contribution of $7,500 in 2023 for a total of a $30,000 contribution. Well, once year 2025 rolls around, you can actually put in more because you're over age 60. So 150% of the regular $7,500 contribution is an additional $37,500. That means that the individual over age 60 can now put in a total of $33,750. And once this takes effect in 2025. So it's a way to juice up that catch-up contribution. It's also been said that for certain high income earners, which is identified as those over $145,000 of income in the previous year, that additional catch-up contribution has to go into the Roth account. You can't defer tax on the contribution because, again, Congress wants that tax money today, but also wants to continue to encourage retirement savings. The next change is 529 rollovers, 529 plan rollovers. Something I'm a huge fan of because I think this is long overdue. For a beneficiary that has a 529 balance, and maybe they've now graduated college, but there's money left in the 529. Now the rules say that they can roll that money into a Roth IRA. This goes in effect in 2024, so we cannot yet do it in 2023. The beneficiary of the 529 has to have been listed as the beneficiary for at least 15 years. They have to have been the beneficiary for those 15 years, and you must also follow Roth IRA contribution limits, which today is $6,500. So let's say I have $20,000 left over in my daughter's 529 plan, and she graduated college. And that 20 grand is just sitting there. If she cashed it in, any gains would be taxable, plus there'd be an applicable penalty for not using that money for college. But what we could start doing in 2024, assuming that she's been the beneficiary for 15 years, is we can start doing a rollover of $6,500 per year from the 529 plan to a Roth account. For her, that gives her a great jump start on her own retirement savings. So this is going to create some important beneficiary planning around 529 plans that we need to think about if you're using those vehicles for college savings. The next one is for our self-employed clients. We've always been able to defer taxes and create really easy to administer retirement plan options, traditionally for a lot of sole proprietors. This is the SEP plan or the simple IRAs. Now, in this bill and Secure Act 2.0, we now have a Roth option if you want to build up tax-free money instead of tax-deferred money. Instead of doing a traditional SEP or a traditional simple IRA, we now have a Roth SEP or Roth simple plans available for us. And last but not least, for any of our clients that are over age 70 and a half that are charitably inclined, we can do what's called an IRA charitable rollover. This is going to be different than the qualified charitable distribution, which we've done for many of our clients that's over age 70 and a half now. This is where you do a direct contribution right from your IRA to a charity, and it's tax-free. In this case, the distribution goes from your IRA to a charitable gift annuity or a charitable remainder trust. You can be an income beneficiary on that. So let's say you're a 5% income beneficiary on a charitable remainder trust, and you have $500,000 that leaves your IRA and goes to the charitable remainder tax-free. That would wind up giving you a $25,000 a year paycheck for a certain period of time or for as long as you're alive. This is an example of a 5% charitable remainder trust. And then when that trust expires, it could be 10 years to 20 years or listed as upon your passing. Any money left goes to the charity tax-free. So this strategy is a way to potentially suppress your RMDs while you're alive, have an income stream from the charitable remainder trust, and then provide for the charity upon your passing. Of course, the income to you is from your IRA, so it's taxable, but this amount is controlled and may have the impact of intentionally reducing your RMDs. You also won't get a tax deduction for the charitable gift, but of course that's because you're gifting away money that's never been taxed. So again, those are the big new tax law changes coming out of Secure Act 2.0. If you have any questions at all, please feel free to reach out to me. We can talk about how these changes impact your financial circumstances. Thanks a lot, everyone, for listening to this video. I wish you all a happy new year and a very prosperous 2023. Thank you.